Welcome, ladies and gentlemen, to another edition of Accounting 101 made simple by Jay Ham. Today's topics discuss lesson number 7. We will cover contingent liabilities on the balance sheet, lawsuits payable, and warranty liability. Lawsuits payable is a contingent, and contingent is based on the outcome of a future event. It's a contingent liability account that contains the amount the company owes to the opposing party in a lawsuit. Liabilities are only recorded in this account if the amount to be paid is both probable and can be estimated. I'll repeat that again. Liabilities are only recorded in this account if the amount to be paid is both probable and can be estimated. For an example, a former employee sues ABC Company for wrongful termination. ABC Company hires an employment lawyer to represent them in the case. The lawyer assesses the lawsuit and determines that it is probable that the plaintiff or former employee will win the case and be awarded $500,000 by a jury. Because the lawsuit is both probable and can be estimated, ABC Company will record the liability in its lawsuit payable account. Depending on when the lawsuit will be paid will determine whether the contingent liability will be classified as current, satisfied, or paid within the next 12 months, or non-current, satisfied, or paid off in a time period greater than the next 12 months. Moving on to warranty liabilities. Warranty liability is a contingent liability of a company in which the company records the amount of the repair or replacement cost that it expects to incur for products already shipped or sold, or for services already rendered or provided to its customers. The warranty liability should be recorded in the same reporting period in which the related product or service sales are recorded. For an example, say if Sleepy's sells a puffy mattress to a customer for $2,400 and has a 1-year warranty on the mattress, and the replacement cost of the mattress is $1,200. At the end of every month, Sleepy would record 1/12 of the replacement cost of the mattress to cover the warranty, which would be $100 per month. So you would take that $1,200 and then you would recognize that ratably over the warranty period, which is 1 year. So you're taking $1,200 and you're dividing it by 12 to come up with $100 per month. Whenever the warranty is redeemed by the customer, Sleepy's would decrease the warranty liability in the inventory account simultaneously to reflect the transaction. This will be covered more in depth when we discuss warranty expense on the income statement. Problem time. Question number 1. A resident of New York City sues the City of New York for injuries stemming from a cracked public sidewalk. The City of New York hires an injury attorney to represent them in this slip and fall case. The attorney informs the City of New York that it is probable that the plaintiff will win the case. However, the lawyer could not provide a reasonable estimate as to how much the liability will be. How would the City of New York record this contingent liability on its balance sheet? Now remember, when you're tackling large questions like question number 1 here, always look at the last sentence of the question. So if the question is a paragraph, take the last sentence of that paragraph to get a gist of what the question is really asking you. So what is the last sentence of the question? It's how would the City of New York record this contingent liability on a balance sheet? So what this question is really asking you is to determine what the contingent liability, if any, is. So now we can go down to our potential answers. And when we're assessing our potential answers, we always know, as that permanent side note suggests, that when solving multiple choice questions, Always eliminate the obvious wrong answers to increase your odds of answering the question correctly. So let's begin with answer A, 500,000 to the accounts payable account. Why is this wrong? This is wrong because accounts payable is not a contingent liability. Accounts payable is an exact liability, so we could rule that out as one of the correct answers. Now let's move on to answer C, 500,000 to the accrued expense account rather. Well, what are accrued expenses? Accrued expenses are contrary to accounts payable in that accounts payable represents the exact liabilities of a company, whereas accrued expenses represents an estimation of liabilities of the company. So we can rule that out. So we'll go to $500,000 to the lawsuits payable account. Now, that might seem like it's the correct answer because we have the lawsuits payable account right here and we're talking about a lawsuit. However, $500,000 is never mentioned in a question. So what is the answer? Remember the criteria for recording a contingent liability. And what is that? That it's probable and also it can be estimated. So in this question, question number one, while it's probable that the plaintiff will win the case, the lawyer couldn't provide the defendant with a reasonable estimate as to how much the liability will be. So because both criteria are not satisfied, no entry would be required, so it would be D. So D, no entry required. And I put a side note here, only lawsuits that are both probable and can be estimated are recorded as contingent liabilities. In this question, it's only probable. Question number 2. A resident of New York City sues the city of New York for injury stemming from a cracked public sidewalk. The city of New York hires an injury attorney to represent them in this slip and fall case. The attorney informs the city of New York that it is probable that the plaintiff will win the case and that the lawyer reasonably estimates that the plaintiff will be awarded $400,000. How would the city of New York record this contingent liability on its balance sheet? Now, again, looking at the large questions, always look at the last sentence of the question. How would the city of New York record this contingent liability on the balance sheet? So we know that the question wants to know what is the contingent liability, if any. So we know what the criteria is for recognition of contingent liabilities, and that is that the liability is probable and that the liability can be reasonably estimated. So, is it probable? Yes. Can it be reasonably estimated? Yes. So it does meet the criteria for recognition of a contingent liability. So we would put that $400,000 to the lawsuits payable account. So the answer to question 2 would be B, $400,000 to the lawsuit payable account. And again, I put the note because I always want to stress the criteria for a contingent liability. It's both probable and can be reasonably estimated. That's the threshold for recognition of contingent liabilities. Question 3. On January 1st, T-Mobile sells a $1,200 iPhone to a customer with a 1-year full warranty which covers the cost of the phone. T-Mobile determines that the replacement cost for the iPhone is $600. What would be the balance in the warranty liability account on June 30th if the customer did not redeem the warranty? A, $600 in the warranty payable account. B, $600 in the accounts payable account. C, $1,200 in the warranty payable account. Or D, $300 in the warranty payable account. Now, as that side note suggests, when solving multiple choice questions, always eliminate the obvious wrong answers to increase your odds of answering the question correctly. Because these answers are closely related to each other, we're going to have to perform a calculation. So what is the calculation of determining what a warranty is? So first we need to determine what the replacement cost of the iPhone is. From question number 3, we determined that the iPhone is $600 in replacement cost. So the replacement cost of the iPhone is $600. So we would calculate the replacement cost by taking the $600, dividing it by the number of months under which the warranty covers, which is a year's time, or 12 months. So we take the $600 and then we divide it by the 12 months under warranty, and that equates to $50 per month. And then we multiply that $50 per month times the number of months that transpired or passed, which is from January to June, and that represents 6 months. So $50 per month. So we would take the $50 per month times 6 to come up with the $300. So the answer to the question would be D, $300 balance in the warranty payable account. In the next video lesson, lesson number 8, we will be discussing the following topic: non-current liabilities on the balance sheet, long-term debt. Ladies and gentlemen, if you like my work, please hit the like button on this video. Please subscribe to this channel. Please share this video on all your social media, and please sign up to become a Patreon member to receive exclusive benefits such as one-on-one tutoring, one-on-one consultation, and more intricate examinations to enhance your learning experience. May God bless you, and see you in the next video.